How do you connect hundreds of thousands of AI GPUs together without, literally melting the cables? It sounds kind of like a sci-fi problem, right? But honestly, this thermal bottleneck is the single biggest physical challenge facing the massive AI data center boom right now. Welcome to the Explainer.
So to solve this intense thermal limit, the industry is turning to OCS, that's optical circuit switching. Basically, by using dynamic optical switches and lasers, data centers can totally eliminate those expensive, power-hungry electrical conversions. Instead, they just beam data directly across the network using LITE. We're essentially upgrading the internet's nervous system from old-school copper right over to pure light.
And that brings us to the focus of today's explainer, Lumentum Holdings, ticker symbol LITE. We're going to uncover exactly how this specific, kind of under-the-radar hardware company is capitalizing on the whole AI revolution by actually building this cutting-edge optical infrastructure.
We've got some fascinating ground to cover today. First, the AI optical revolution. Second, exploding revenue and margins. Third, a wild $7 billion accounting illusion. Fourth, benchmarking the AI premium. Fifth, supply risks and insider sales. And finally, catalysts and our final verdict. Let's get right into it.
Section 1. The AI optical revolution, moving beyond the physical limits of copper.
So, as AI models get smarter and way more complex, they require hundreds of thousands of GPUs to talk to each other in literal microseconds. But here's the problem. Traditional copper cabling is hitting a physical wall. It gets too hot, its reach is way too short, and it's simply too slow for this kind of traffic. Put simply, if you try to run next-gen AI on copper, you're essentially just building a massive, incredibly expensive space heater.
While Lumentum steps in to fix this exact issue with highly specialized optical solutions. Their co-packaged optics, or CPO, deliver high-power lasers directly right to the compute racks. They also use external laser sources to create just ridiculously fast chip-to-chip connectivity. And by embedding Photonics straight into the AI fabric with near-packaged optics, they're rapidly expanding their total addressable market. This is especially true in telecom data center interconnects, which is a space projected to hit $4 billion by 2029.
Okay, moving on to Section 2, exploding revenue and margins. Hypergrowth realized in FY 2026.
The sheer scale of this financial jump is just wild. Full-year net revenue absolutely skyrocketed from $1.645 billion in fiscal 2025 up to over $3 billion in fiscal 2026. Think about that. That is a staggering 83.2% year-over-year expansion. They aren't just out there talking about the AI boom, they're actually capturing it in real hard dollars. Breaking down that record-setting fourth quarter, their component segment really drove the lion's share of the revenue. We're talking almost $650 million, or roughly 64% of the whole pie. And that is heavily fueled by the demand for those ultra-high-power CPO lasers we just talked about. Meanwhile, the remaining 35.5% from their systems segment is also growing incredibly fast, thanks to a massive backlog in optical circuit switching.
Now, here's why that really matters. In the fourth quarter, their non-GAAP gross margin actually crossed the 50% threshold for the very first time in corporate history. 50.4% to be exact, because their revenue growth is so wildly outpacing their fixed overhead costs, things like running the factories, they're able to convert that massive top-line expansion directly into deep bottom-line profitability. Hitting a 50% margin in the hardware space, that is a massive flex. Which brings us to a really interesting twist in Section 3, the $7 billion illusion. A shocking Q4 plot twist.
Negative $7.2 billion. Yeah, you heard that right. That is the GAAP net loss Lumentum reported for their fourth quarter. On the surface, you have to ask, how do you double your revenue and somehow manage to lose $7 billion? It sounds like an absolute disaster, doesn't it?
Well, to demystify this, we really have to look past the strict GAAP accounting rules and focus on the operating reality. That $7.2 billion loss, it was entirely driven by a one-time non-cash charge. If you actually look at their non-GAAP net income, which tracks the actual real money flowing in and out of the business, they were positive $326.3 million. So this was literally just a paper loss, not an actual cash drain.
So how does an illusion like that happen? It all comes down to a quirky accounting rule with convertible debt. Here's the deal. Step 1, Lumentum's stock price goes on an absolute tear, skyrocketing past $800. Step 2, because the stock price got so high, $1.1 billion of their debt converted into equity, way above the original strike price. And step 3, GAAP rules bizarrely mandate that they have to mark this converted debt to the new, massive market equity value. So ironically, just because their stock performed incredibly well, accountants forced them to record a massive $7.8 billion non-cash loss when retiring that debt. Wild, right?
So the real takeaway from this accounting quirk? It's actually incredibly bullish. By wiping out all that debt, they reduced their total obligations by 35%. And on top of that, they secured a rock-solid balance sheet with $2.7 billion in liquid cash just preserved and ready to fund their future expansion.
Okay, let's look at Section 4, Benchmarking the AI Premium, Valuing the Optical Leader Against Its Peers.
When you put Lumentum side by side with peers like Coherent, Arista Networks, and Corning, one thing immediately jumps out. Lumentum trades at a massive premium. We're talking a 27.2 times trailing price to sales multiple. That completely leaves legacy peers in the dust. But look at their growth. That premium exists because of their staggering 83.2% year-over-year revenue growth. The market isn't pricing them as a slow, legacy hardware company anymore. They're being priced as a pure-play AI engine. Now, while that trailing valuation looks frankly incredibly steep today, the market is looking ahead. Their Q1 fiscal 2027 guidance projects non-GAAP earnings per share of $4.20. And that explosive near-term earnings power quickly compresses that forward price-to-earnings multiple down to about 52.5 times. Suddenly, that looks a whole lot more reasonable for a company that's heavily tied to hyper-growth AI infrastructure.
But we have to stay objective. Let's move to Section 5, Supply Risks and Insider Sales, the headwinds to watch.
It is definitely not all smooth sailing, though. There are some major headwinds we need to keep an eye on. For one, they're facing a severe capacity bottleneck. Right now, global demand is completely outpacing what they can actually manufacture by more than 30%. Also, insiders are taking some chips off the table. We've seen executives make 39 open market sales totaling almost $30 million over the last 6 months, with 0 open market purchases. Combine that with the equity overhang from a 27% increase in outstanding shares, plus their heavy reliance on just a small handful of hyperscale cloud providers, well, it means if big tech suddenly decides to pause spending, Lumentum is going to feel it immediately.
Finally, that brings us to Section 6, Catalysts and Final Verdict. Looking to the horizon.
Looking at the timeline moving forward, here's what to watch. In the short term, meaning the next 12 months, we're looking for Q1 earnings validation and the commercial ramp of their new 1.6T transceivers as immediate proof points. Pushing out 12 to 24 months, the major catalyst will be the broad adoption of that in-rack optical architecture. But the really huge milestone, that's in the 12 to 36-month window, waiting for the completion of their brand new North Carolina manufacturing facility in 2028. That plant is purpose-built to finally unblock that massive 30% supply chain deficit.
So compiling all the institutional research and data, the final verdict shakes out as a high-confidence buy over the next 6 to 12 months. The rationale here is really compelling. They've got a totally dominant AI optical footprint, they just successfully crossed that magical 50% margin threshold, and they've got a brilliantly de-risked balance sheet. Right now, for a lot of analysts, those strengths heavily override the near-term valuation and supply concerns.
I'll just leave you with this final thought to ponder. If optical networking is truly the hidden nervous system of the AI boom, is Lumentum the ultimate picks and shovels play for your portfolio? Thank you so much for joining this explainer. Keep exploring the infrastructure that's powering our future, and we'll catch you next time.